Welcome, everybody, to the Kevin MD Wall Street Alliance Group webinar, Biden's tax proposal and effects on financial planning for physicians. My name is Kevin Poe, founder and editor of Kevin MD. I'm also the host of The Podcast by Kevin MD, the only daily medical podcast. 15 minutes a day, 7 days a week. Listen and subscribe on your favorite podcast platforms. This evening, I'm joined by Syed, Nishat, and Aadil, Zaman. They are partners at Wall Street Alliance Group. Syed is a regular contributor for Kevin MD, and their articles and interviews about asset protection and common financial mistakes by physicians are published in MedPage Today and Medical Economics. Syed and Aadil are regularly quoted and interviewed in media outlets like Forbes, US News, Bloomberg, and Yahoo Finance. They can be reached at www.wallstreetag.com. That's www.wallstreetag.com. This evening's webinar is an interactive webinar, so please ask your questions in the chat box. I will stop and ask Syed and Aadil your questions throughout the webinar. Also, this webinar is being recorded and will be posted throughout the Kevin MD platform. Now, let's get started. Can you please explain the latest on President Biden's tax law proposal and how it impacts physicians?
Great to be with you, Kevin. We at Wall Street Alliance Group do wealth management for physician families. And there are two categories of physicians that are going to get impacted by this proposal. The first category is physicians that make more than $400,000. These physicians, the top marginal tax rate for these physicians is going to go up from 37% to 39.6%. So that's a 2.6% increase in tax. Secondly, the Social Security tax is going to go up for this group. So the Social Security tax for the portion of the income that they're making over $400,000 is going to be 12.4%. And for a lot of physicians that are making income in that category, they take something called itemized deductions. So for itemized deductions for those making more than $400,000 is going to get phased out. The second category of physicians that is going to get impacted by this is those that are making more than $1 million. So the long-term capital gains tax rate for them is going to go up to 43.4%. That's about 20% higher than where it is right now. So what does that mean, Kevin? That means that if you have, a stock of Apple that you bought, or a real estate that you bought, and you have a profit in it and you sell it after a few years, then the taxes that you're going to pay is 43.4%, which is about 20% higher than what you would right now. So these are significant increases in taxes, and there are planning strategies that need to be implemented to safeguard against these.
Can you explain what strategies physicians can use to keep their tax bracket low so that they are not impacted by both the high marginal income tax rate and the high capital gains tax rate?
Sure, Kevin, for asking this question. And we want to start by thanking you and all the healthcare providers for their hard work and sacrifice during this pandemic. As Aadil mentioned, that the magic number we're looking for physicians, they will get impacted the most, those earn over $400,000. So ideally, you'd like to come up with some strategy that can overall lower your income. And now the best way to lower your overall income or adjusted gross income is when you contribute in a retirement account. Like every $10,000 you contribute into a retirement account, not only you get a deduction, but if you're in a 35%, for example, tax bracket, you save or almost around close to $3,500 in taxes. There are different types of retirement account out there, but I just want to share my screen with you just to give you an idea how defined benefit plan works or cash balance plan works. It's not uncommon for a physician to do locum or have 1099 income beside the hospital or self-employed. So if you're self-employed, you can, if you're 60 years old, for example, you can contribute into a defined benefit plan or a cash balance plan almost $260,000, and this money is completely tax deductible. So if you're in a 35% tax bracket, we're looking at a tax savings of almost $90,000. If you're looking for not to contribute too much money, but lesser amount, you can always consider opening a SEP IRA account. In a SEP IRA, you can contribute 25% of your W-2 wage or $57,000, whichever is less. Or straightforward IRA account, husband and wife over the age of 50 can contribute almost $7,000 each every year. And again, these are pre-tax money. And lastly, a lot of physician, Kevin, has HSA account either through hospital or their own practice. HSA means high deductible health insurance account for the family. You can contribute almost $7,100 from your salary. And this money can be also out of your income as well. Everyone's situation is different, but the first point of strategies we recommend that max out your SEP IRA or your cash balance plan if you're self-employed to lower your overall income.
So one of the questions that I have from the audience is about estate planning. And especially during the pandemic, we've had so many physicians wondering about what their estate plan is. I have a lot of physicians on my podcast and on my blog. They ask me, what are the pitfalls when it comes to estate planning and wills? So I'm going to ask either one of you, what are some of the top estate planning mistakes that physicians need to avoid?
When we do estate planning, the number one mistake we see that people just create a basic will, and that's it, there's no trust. So will is basically a legal document that specify what will happen to you if anything happens to you, who will get the distribution of the property. But if you just have a will, no trust, depending on the stage you live in, the trustee has to take the copy of the will and send it to the judge. And the judge actually have to authenticate it and then release the money. This takes time. It's called a probate process. And some states, the probate process is almost around 4 months to even 7 months. Meanwhile, the beneficiaries need access to the money. They cannot have access to the money. So the number one mistakes we see is just having a will, no revocable trust. So physician is not uncommon to have substantial amount of assets. So make sure not just have a basic will, have a revocable trust as well. And Aadil, you can point out a couple of mistakes as well.
Yeah, I think one of the mistakes that, Kevin, that we see people make is that they'll have a trust, but they'll distribute the assets to the kids outright. And now if the child goes through a divorce or the child goes through a creditor issue, those assets very easily get depleted. So the key over here is that when you give the assets to your children, give those assets to the kids inside of an irrevocable trust. And that irrevocable trust should be a lifetime trust. So in the case there's a divorce, in the case there's a creditor issue, those assets are protected, but at the same time, they remain accessible if the child needs them.
Someone is asking, what tax year do these new taxes kick in?
These the capital gains tax is going to kick in for this year. And we are waiting for clarity on the other taxes. All of these could potentially be effective 2021 onwards, but we are waiting for some more clarity as far as the guidance is concerned.
For physicians who work in the hospital employed physicians, what options from a tax standpoint are available to them?
So physicians who are not self-employed and they're actually hospital-based, they should definitely max out their 401k and 457 plan. In a 401k and a 457 plan over the age of 50, you can contribute almost $26,000. And again, all this money are pre-tax. Also, some physician overlooked a 409A plan. It's not provided by all the hospital, but depending on your employer, speak to them if they offer a 409A plan. The difference between 409A and a 457 plan, you can defer almost 90% of your salary and all the money are pre-tax. The problem with the 409A plan that in an event, if a bankruptcy happened, the assets are not protected, similar to 457 plan. So we're not suggesting put a lot of money into it, but depending on your tax situation, if you have a lot of disposable income, consider speaking to a financial advisor about contributing some money into a 409A plan. Now, once you max out the 401A, 401K, 457, and 409A, a lot of physicians overlook doing something called a backdoor Roth IRA. So a lot of physicians think that they don't qualify for a Roth IRA because of their higher income limit. But backdoor IRA is a strategy where you don't have to worry about income restriction. The way the backdoor Roth IRA works, you open a post-tax IRA account. Same time, you open a Roth IRA account. you contribute into the post-tax IRA and immediately convert the money to a Roth IRA. Now, since you're converting the money immediately, there's no taxes on the principal, and the taxes on the profit will be very minor because you're doing instantaneously. But once you have converted the money to the Roth IRA, the funds will grow tax-free. The withdrawal is also tax-free after the age of 60, and it's extremely powerful, especially after 5 years. If you just waited after you open a Roth IRA, the funds can be used to buy qualified house if you are residents, and you can take out $10,000 from a Roth IRA. Actually, is all tax-free. And if you're going to college, a lot of qualified expenses could be done through a Roth IRA. So I think it's extremely powerful. And me and Aadil, Kevin, we're talking to a client of ours who are in New Jersey, how powerful the backdoor Roth IRA, and he can give an explanation.
Yeah, so we've had a long-term relationship with this couple, husband, wife, both physicians, and they've been diligently contributing to the Roth IRA $7,000 a year. And we were just doing a math that if you're doing $14,000 a year over 20 years, that's about more than $600,000 that's accumulated, assuming a 7% per year rate of return. And that's a sizable chunk of money because it's growing tax-free and the withdrawals are also tax-free. So really a very solid strategy for physicians to take advantage of.
Are there other tax deduction vehicles besides retirement accounts?
Besides the retirement account, we're talking about other sources of income. For example, if you have real estate income or if you have some passive income, what are the strategy for that? For example, we see a lot of physicians invest into real estate. Since 2018, real estate has been very popular. But once you invest into real estate, try to invest into something called opportunity zone. What does it mean? Opportunity zone basically means that you're investing into an area, there's a 20% probability rate. Once you buy a property, a hard property into an opportunity zone, you hold on to the assets for 10 years. When you sell it, there's no capital gain tax in it. You can actually create your own LLC and title as an opportunity zone and can defer taxes in it. So I'm just actually giving you the ideas. They're more into opportunity zone, and there's no way I can cover all of this. But again, speak to a financial advisor if you invest into real estate, if opportunity zone makes sense for you. Secondly, 60% or more of our physicians we deal with, they actually have their own practice. If they have their own practice, we do see they actually pay themselves for rent, or they actually invest into surgical center. These are very common, like if you're a nephrologist and oncologist. So if you have your own property, consider doing something called a cost segregation. In a commercial real estate, the depreciation schedule, Kevin, is about 39 years. What it means that the depreciation happens every year, you get to write off from the income from the property. Cost segregation, all it does, it depreciates the property faster. From 39 years, it brings it down to 5 years. So in this way, you actually have a bigger depreciation. You can get to write off this depreciation from any income. Just to give an idea, Aadil and I, we had a client in Texas, surgeon. He invested into a surgical center for $1 million he bought last year. We did advanced cost segregation. For $1 million, we got a depreciation advanced $250,000. And any income derived from the property, that client doesn't have to worry about paying any taxes up to $250,000. So again, cost segregation, if you have your own practice or invest into real estate, consider that. And charitable contribution, also a great way to reduce your overall income if you're charity minded. But again, there's no way I can cover because charitable contribution could be a webinar of its own. But just to give you an idea that if you are charity minded, we can open up a charitable remainder trust, set up in such a way that you can actually get income from the charitable foundation as well. But again, speak to a financial advisor about opportunity zone, cost segregation, and charitable contribution. That will help you to lower your overall income.
All right, I'm going to go back to the audience questions, and we have a few. My accountant said that since I have an old small Roth plus a maxed out SEP and 401k, I'd actually pay taxes twice on any money I put into a backdoor Roth. Is that true?
Yeah, so you have to understand that the way the backdoor Roth IRA works. So what your CPA is trying to explain something called a conversion ratio. What I mean by conversion ratio, let's say you have an old SEP IRA, value is $50,000. I'm giving an example. You open up an IRA account and put $5,000 in it and convert it to a Roth IRA. You're expecting the $5,000 should be converted, right? Since the problem is going to be, since you already have an existing old SEP IRA that the audience is mentioning, it will not be all 5,000. You have to divide 5,000 by the 50,000 old SEP IRA you have. So the ratio will be only 10%. So it's called conversion ratio. That's the problem you're going to face it. So it's not going to work if you have existing SEP IRA account open. So the best way to handle it, if you have old SEP IRAs, old IRAs, merge all of it to a 401k plan, like through hospital, or if you have your own self-employed 401k, because at that time, the conversion ratio doesn't matter. So the solution to this conversion, merge all the money to the 401k, open up a brand new IRA account, and then convert it to a Roth IRA.
How much can you put into a backdoor Roth IRA?
You can put $7,000 into an IRA, and then you can convert it to a backdoor Roth IRA.
What do you mean by no open IRA to take advantage of the backdoor IRA?
Yeah, so what I mean by that if you have an old IRA account and if you have a balance into it, that balance will be counted towards the conversion. So what we are saying that if you have an old IRA, merge it with a 401k, then open up a brand new IRA account and then convert it.
And the audience question in this segment, someone's asking, can you explain a SLAT, the Spousal Lifetime Access Trust?
A SLAT is basically an irrevocable trust, right? Which, let's say if you're a physician and you're in a high risk of lawsuits, for physicians, like it or not, lawsuits are a reality. Asset protection becomes very important. You're a physician, you want to protect your assets. What you could do is you could open an irrevocable trust for your spouse. And you could gift the assets into the spousal trust. That's an irrevocable trust. Now they're out of your estate, you get sued, those assets are protected because they're in your spouse's irrevocable trust. Now the question becomes that, hey, I put all this money in my spouse's trust. How do I get access to money for my expenses and day-to-day living? For that, there's a rule that the spouse can give you unlimited amount of gifts. So the spouse can make the withdrawals and pass those along to you. So it's an important tool when it comes to discussing asset protection for physicians.
What are President Biden's proposed estate planning changes and how will they impact physicians?
So what Biden wants to do is that he wants to get rid of step-up in basis. Now, the way step-up in basis works, just to give you a simple example, if you bought a stock of Apple, let's say, bought it for $100, at the time of your death, the price of Apple is $500, right? Under the current rule, your cost basis for your inheritors, might be your kids, it's going to go up to $500. So if they sell Apple, there will be no taxes due because their cost basis has stepped up. What Biden is saying is that I want to close this loophole. If he's able to close this loophole, just to give you a simple example, this is how it's going to work. So you bought the stock of Apple at 100. At the time of your death, Apple is at 500. On the $400 in profit, taxes will be due on the year of your death. Now, because a lot of people conceivably could be in the year of their death, have substantial capital gains, what that could do is that could bump up your long-term, your income above $1 million, and then you would be subject to the 43.4% long-term capital gains tax. Parallel to this, Kevin, what's also happening is that the current estate tax exemption amount is $11.7 million. So what that basically means is that if you die and you have assets that are greater than $11.7 million, for the portion that is above $11.7 million, there will be 40% approximately estate taxes due. That limit is set to go down in 2025 from 11.7 million to 5.49 million inflation adjusted. So what does that mean for physicians that are listening to this broadcast? If you have worked hard all your life, you've accumulated a net worth of 11, 12 million, you pass away, you could have substantial estate taxes due as well. So now think about it. If this proposal goes through, at death, there'll be capital gains taxes. At death, there will be estate taxes. And because of this, the Tax Foundation did a study and they said that some families could face a combined tax rate of as much as 61% on inherited wealth. So this is a significant increase in taxes. And what we are recommending is estate planning strategies to reduce the impact of this increase.
And that's going to lead me, of course, to my next question. What are some of those estate planning strategies for physicians to avoid high taxes at death?
So these are just some of the strategies, Kevin, that we are using at Wall Street Alliance Group for our clients. So one is that you can lock in the current high exemption of 11.7 million by gifting it to an irrevocable trust for the benefit of your family, right? So yeah, so this way that 11.7 million is out of your estate, it grows estate tax free, and it is for the benefit of your family. Now, tomorrow they turn around and they reduce the limit down to 5 million. You're not impacted by it because you already locked in the 11.7 million by doing this. The second thing to note in this is that if you have appreciated assets and you gift into the irrevocable trust, then you don't owe capital gains tax on that gift as long as you do it this year, as far as the proposal stands right now. If you do it next year, you do the same thing, capital gains taxes would be due. So there's a small window of opportunity to do this tax efficiently. Secondly, if you have children, husband, wife combined could gift $15,000 each per child. So total $30,000 you could gift per child every year, get it out of your estate, growing estate tax free. You could also, if you're anticipating a significant amount of estate taxes, what you could also do is purchase a second to die life insurance policy, which would pay a death benefit at the death of the second spouse, which is typically when estate taxes are due. And the proceeds can be used to pay off the estate taxes. And you could take it a step further. And if you have life insurance, you could move it inside an irrevocable trust so that the death benefit would remain out of your estate and there will be no estate taxes on it. And lastly, you can use, if you're charitable minded, you can use some charitable trust strategies, which would essentially enable you to give some money to charity, give some money to your beneficiaries, and reduce the estate taxes. So these are, customizable strategies. There's no one size fit all, but these are some of the strategies that we are working on with our clients.
All right, let's go back to those audience questions. So one question I have, is a life insurance benefit taxable?
The life insurance is, there's no income tax in it, the life insurance, but the benefit is part of your estate during calculation. So what I meant by that, like Aadil mentioned, that 11.5 million per person, husband, wife, both dies, then it will be part of your estate. So the life insurance proceed will be calculated towards the estate. So the best way to handle it is move it to an irrevocable trust, like Aadil mentioned, so that that benefit will not be part of your estate.
The next question, can you speak about the conservation easement contribution as a help to decrease taxable income?
So I can speak a little bit, and Aadil, then you can talk from your experience too. So conservation in easement, basically you get a higher deduction. There's a lot of projects out there, depending on the state, you can invest into it. The reason why people do it is the deduction is 4 times of the amount you contribute. So let's say if you put 100,000, sometimes it's 5 times, like $500,000, you get a deduction. The issue is that a lot of people misuse it, a lot of high net worth individual, and that it is due. A lot of times we see a lot of audit happens. And Aadil, you can talk about the experience we have it, whether it's worth it or not.
Yeah. So this is a high risk item. This is on the radar right now. So there, like what Syed was mentioning, there are a lot of other strategies which are cleaner, safer, and more effective. Like the cash balance strategy is a low risk strategy. It's a great thing. You save a decent amount of money in taxes. So the cost segregation analysis to get accelerated depreciation, we would, at a time like this, we would guide you to take advantage of those strategies more.
Are there any recent changes in tax laws, like the Secure Act, that physicians need to be aware of in estate planning?
Yeah, so we'd like to just point out one more thing in this webinar, which is called Secure Act. This is not part of the Biden's law. This is already a law in the year 2020. Secure Act means setting up the whole community up for retirement in Act that was passed in the year 2020. Before Secure Act, the way the process would work, the inheritance would work. If anything happens to you, your beneficiary inherit the money. They have their whole life to stretch the benefit. So what I mean by that, let's say you have a $5 million in an IRA account, husband, wife both pass away, your children inherit the 5 million, they have their whole life slowly to withdraw the money, but meanwhile the money can grow as well. It's the whole idea called stretching. That went away last year. Now, due to Secure Act, what happened, this $5 million now you inherited in the same example, you have to exhaust it within 10 years. So either in this situation, $500,000 in 10 years, every year you can withdraw 500,000, or at the end of 10th year, you have to withdraw all 5 million. You might be saying, okay, what's the big deal? The problem is that you actually have to worry about a huge amount of taxes that's due within 10 years. Previously, you can stretch it out. That's an issue. So it's not uncommon. We have seen for physicians, they put most of their money because they're professionals. So they work for the hospitals. They put most of their funds into the retirement account, 401k. So they will be impacted a lot. Is already a law. So they should speak to your financial advisor about incorporating the income tax that might be due from Secure Act.
What are the ways to reduce a tax burden from the Secure Act?
Yeah, so the solution for Secure Act are somewhat similar to the solution Aadil has mentioned for estate tax solution as well. For example, you can buy a cheap second to die life insurance policy, which are very cheap. If anything happens to husband and wife, then the life insurance kicks in. That can pay for the income tax that will be due for the income derived from the IRA account. This could be one solution. Second solution could be that you can do something called a Roth conversion of, we spoke about the backdoor Roth IRA or Roth IRA. Remember, in a Roth IRA, it's the same law. In 10 years, you have to withdraw it, but also in Roth IRA, there's no taxes though, because it's gross tax free. So that could be second option. Third option could be that as a financial advisor, we usually recommend our client to withdraw Roth IRA first, then joint account, leave the IRA for children. But due to Secure Act, one option could be you can start using IRA account for yourself during retirement and leave the Roth IRA for your children for a long period of time. So in this way, the money can grow long term as well. Or if you're charitable minded, you can actually, after that, give some proceeds to the charity and derive as an income as well. Or it could be a combination of all of it, but everyone's situation is different. There's no one cookie cutter solution for anyone. But that's why it's important to speak to a financial advisor. Depending on your situation, can customize a solution for you.
Great. So let's go back to our last segment of audience questions. I have incurred a substantial gain from stock investments this year. Do you have any advice to lower taxes?
Yeah, so I will share one idea, and Aadil, you can share one idea too. So from stocks, if you have substantial amount of income, we spoke about opportunity zone. So one option could be you can defer money depending on the date you actually have sold it, capital gain. You can create an LLC and transfer the money and defer the taxes. The way the opportunity zone works, within 180 days, you have to identify the property, invest the money. As long as you can identify it and then hold the property for 10 years period of time, there's a way you can defer the taxes. Again, it's for long-term minded people as well. And Aadil, you can share some of your ideas too.
So if you've incurred the gains last year, typically, if you adopt a cash balance plan, which Syed spoke about, typically you have to do it within the year. But because of COVID and because of some adjustments, if you haven't filed your business tax returns as yet, you can actually, for last year, if you're self-employed, you could actually adopt the cash balance and contribute to it and make a significant amount of contribution to reduce your overall taxes. And as long as you haven't filed your business returns, that's a pretty effective strategy. We've had a number of cases that we've actually done this for. If it is this year, you can do the same thing. There's also something called tax loss harvesting. This is a strategy we used extensively in 2008. If you have a stock that is at a loss, you could sell that stock and buy it. As long as you don't buy it back within 30 days, you could use that loss to offset gains. And if you still want the equity exposure, you could buy something similar, which would still give you that upside, or buy that stock back within 30 days. So this is just to give you a flavor of a couple of things we have, but there are a number of strategies that we can use to actually reduce that tax burden.
So I have a question here about a special needs trust. So if you on death have a beneficiary that is directly related to an established special needs trust, does the trust have to pay taxes on it as a person would? The trust is not for an immediate family member.
Yeah, so the special needs trust, we do a lot of advanced planning. So I'm hoping the person who did it, either it could be a special need trust, could be revocable or irrevocable, could be both. Any money that goes to the special need trust must be used for the child who has special need. That's the must thing. But that money that you inherited, remember again, after that, if you just inherit the money, so it is part of your estate, obviously. But as Aadil mentioned, that depending on what's the value of your estate, so if you bought the step up is going away, so that still remain though. So you do have to worry about paying some taxes depending on the amount of your net worth is. But once you put the money, after paying the taxes, step up goes away. If you invest into any stocks, charity, the trust itself will have to pay the taxes, but the money can be used ultimately for the benefit.
We are approaching the conclusion of this webinar, and I want to ask each of you for your take-home messages. Once again, we are talking to Syed, Nishat, and Aadil Zaman. They are partners at Wall Street Alliance Group, and they could be reached at www.wallstreetag.com. That's www.wallstreetag.com. So, Aadil, I'm going to start with you. What is your take-home message from this webinar?
So, Kevin, people that make doctors, physicians that make more than $400,000, for them, estate planning, tax planning, and asset protection are extremely important. And what happens is that, life circumstances keep changing, rules keep changing, and physicians, with their day job, they're extremely busy. So what we tend to notice is that people in this category, income category, tend to have a lot of blind spots. And it is very important that you work with a fiduciary financial advisor who can look at the full 360-degree angle and help you safeguard against those blind spots and plan for them.
And Aadil, what do you mean by a fiduciary financial advisor?
So, Kevin, as a physician, you are a fiduciary. So that means that it is your legal responsibility to act in the best interest of your patients. In the same way, as a financial advisor, we have the fiduciary, we work in a fiduciary capacity, where it is our legal responsibility to act in the best interest of our clients. Not all financial advisors are fiduciary. In fact, there was a research done by PBS Frontline many years ago, which concluded that only 15% of financial professionals work in the fiduciary capacity. So if you're working with a financial advisor, it is prudent to work with a fiduciary.
And Syed, what is your take-home message from this webinar?
The whole financial planning cannot be complete without talking about asset protection. And as Aadil mentioned, that physicians are in a high-risk profession. There's a statistic done by American Medical Association. 60% of physicians over the age of 50 get lawsuit at least once. And this statistic is quite high for certain professions like OBGYN and surgeon. So make sure that when you create a financial plan with a fiduciary financial advisor is designed in such a way that if a physician get a lawsuit, the assets are protected. That's number one. And number two, when we talk about this Biden tax law planning and the Secure Act, if you can see, there's a lot of moving parts. It's just not like one solution we can just suggest. So it involves speaking with the CPA, actuary, attorneys, and come up with a customized financial plan. So make sure when you deal with a fiduciary advisor, the advisor, he or she has a team of experts in-house. So you don't have to go to 10 different places to get the job done. And a fiduciary advisor can take a look at the 360-degree angle and can take care of all your financial planning need under one umbrella very efficiently.
Well, thank you so much for joining me on this webinar. Once again, our experts can be reached at the Wall Street Alliance Group at www.wallstreetag.com. That's www.wallstreetag.com. And that concludes this evening's webinar. Thank you so much for joining me. This webinar will be posted on the Kevin MD platform, and the audio version will be available on various podcast platforms as well. Thank you very much, and good evening.
Thank
Thank
you.
you.